ISIS, ISIS. Do you ever hear anything good on the news? Julie gives me a hard time because I won't watch the nightly news. I just get fed up with it. I still learn what's going on, but just to hear them, I get fed up with it, and I just really don't want to hear it because they always have a negative slant to everything. And when you hear that day in, day out, 24 hours a day, it gets to you, and you start thinking, oh, maybe they're right. It wears you down. It almost becomes Stockholm syndrome. If you're watching and listening to the TV programs and stuff, I'm not kidding. It almost becomes like Stockholm syndrome.
Maria, it's never coming back. Living standards will never be the same. You cannot have an $8 trillion negative wealth effect from housing. You can't have a $10 trillion hit on capital markets. You can't have a bunch of insane government programs and bailouts and everything else. Nothing makes sense. The consumer knows it. It's indefinite. America will never be the same. We have trillion-dollar deficits, Maria, for 10 years.
Well, so you're saying that people are not going to be going in the spend-thrift direction anytime sooner. They'll stay with the discount retailers? Is that what you're saying?
Indefinitely. Maria, this is here to stay. Our country will never be the same. We have permanent damage to our financial system, which is in a depression, residential. It's in a depression. By the way, I think there's a 50% chance we're going into a full-scale depression. That's my view, and it's not getting fixed.
Do you happen to see in the bottom corner what the Dow was on that? 7,500. I think it closed today somewhere around 16 something. If it's never coming back, then why was there a double somewhere between when he spoke in late 2009 and today? It's never coming back, I promise. It's on TV daily. You guys are inundated. And how many people do you think Mr. Davidovich has their money and is investing it? And he's probably still sitting on the sideline. How many lives did he ruin? How many people's future are dashed? They're out there, they've got a bad message, and you've just got to turn that stuff off. It's investment pornography. It really is. All right, so he talked in, it was February of 2009. So $100,000, when he talked, it was probably worth about $60,000. And by June of this year, $211,000. Still a double, even if you started with $100,000. But it's never, ever coming back. Really? Really? What was it? Some kind of space-time continuum? We're just going to be stuck in that moment forever? But he's on national TV, and people believed him. The dysfunctional narrative destroys investors' peace of mind. I'll say it again. Turn it off. Don't listen to it. It doesn't matter. Oh, here's a good one. The death of money, the coming collapse of the international monetary system. Really? What are we going to do? Run around with puka beads and be trading those? You make your car payment, you have to take a big bushel of puka beads down to the bank to trade those in because the death of money? This is the kind of stuff that's out there, and you guys are inundated on a daily basis. I'm hoping that by educating you and coaching you, you'll realize what's going on. It's a war. It's a war for your heart and soul. And I'm fighting it. I'm trying to fight it. Global financial crisis. Oh, here's a good one. That deficit monster. You know when this was? 1984. That's a Time magazine from March 5th, 1984. Now, I'm not saying we don't have problems, but holy cow, you know what the market was? March 5th of 1984? 1,200. 1,200. What did it close today again? Help me out, Marion. What did it close again? 16, 16.2, something like that? Yeah. Mind-boggling.
Let's talk about this perfect storm that it feels like we've got going on. We've got threats from all around the world that China will ultimately slow down. Europe is in the midst of its own, issues in terms of the debt crisis. How significant are these things to the growth of the United States? And what's your take on China right now?
Well, I think that my prediction for a perfect storm is not this year or next year, but 2013, because everybody's kicking the can down the road. We're going to have a problem in the U.S. after the election if we don't resolve our fiscal problem. China is overheating and has fixed investment at 50% of GDP. Eventually, it's going to have a hard landing. The Europeans are pushing their problems, but Greece, Ireland, Portugal need to restructure their debts. They're insolvent, and that's going to be done 2013. Japan is going to have a short-term stimulus. It's going to slack again in a year from now. So I see every economy in the world trying to push the problems to the future. We start with private debt, public debt, supranational debt. We're kicking the can down the road, and eventually all these are going to come to a head in 2013.
Oh, goodness.
As you can see, I have provided everything a child might need. Alright, clearly we need to set some rules. Rule number 1, you will not touch anything.
What about the floor?
Yes, you may touch the floor.
What about the air?
Yes, you may touch the air.
What about this?
Ah! Where did you get that?
Found it.
Okay, rule number 2, you will not bother me while I'm working. Rule number 3, you will not cry, or whine, or laugh, or giggle, or sneeze, or burp, or fart. So, no annoying sounds, right?
Does this count as annoying?
Now, the reason I put that clip in is because one of my favorite annoying sounds is coming up in the next couple of clips. Our good friend, Harry Dent. Harry Dent wrote this book, How to Prosper in the Debt Crisis of 2010-2012, The Great Depression Ahead. But earlier, he wrote a book, The Roaring 2000s. So let's see how good old Harry's predictions really played out. The Roaring 2000s. From 2000 to 2009, the S&P returns a negative 0.95 per year for a minus 9% total return. Roaring 2000s? Yeah, I don't think that was roaring. Now, what I will tell you is our Matson Money growth portfolio, if you had invested in 2000 and stayed invested with us all the way through to 2010, the growth portfolio averaged 7.2%. Now, you had some ups and downs in there because of 9/11 and then the big crash in 2008, but you would have averaged about 7.23%, which, rule of 72, means your money doubled. I'll take a double every 10 years. That's fine with me. I like that. 2010 to 2012, 36% total return, with large U.S. averaging 10.87. Poor Harry, he just can't get it right. And finally, the announcers and the commentators are slowly starting to catch on. Not all of them, because they keep inviting him back. He's wrong all the time, but they keep, I don't know if it's for comic relief or what, but they keep inviting him back to be on the shows.
We've been saying for years the demographic trends, the baby boom spending peaked back in 2007, and ever since the Fed and central banks have been fighting with more and more stimulus, and all they've done, they haven't created inflation as the gold bugs predicted, they created a greater bubble in the markets. Now, I don't think we're quite there yet. We've been saying Dow 17,000 major target. If you look at this megaphone pattern we have, each bubble, the early 2000s,
I don't think there's anything you haven't been saying. I mean, look,
yeah,
you know,
right. But I haven't given a sell signal on the market yet either. We're just saying it's coming.
Didn't you say early last year that we'd already be at Dow 6,000 in this quarter?
No, we did not.
And
Late
2009.
late 2016 is when we're predicting that.
It just feels like the goalpost.
Do you guys have the chart? If you see the chart, it's pretty
We saw the chart.
We showed it
Kenny, do you
already.
buy the
Can you
chart?
bring up the chart? If you don't see the chart, you can't see what I'm saying. Every bubble has gone higher and every crash has gone lower. This is the same topping pattern from 65 to 72 with 3 higher peaks and then the biggest crash in 73, 74. This is not the only pattern that can happen here, Kelly or Bill, but it is something that people should be looking at, and people see no risk in a market with the highest debt levels and worsening demographic trends around the world. I'm not saying this is peaking yet. It's going up about 1% a month. It'll go up until something goes wrong.
I'm just saying that the predictions have been kind of all over the place. Kenny?
No, they haven't. We've been very consistent about this.
Listen, I look like a ray of sunshine compared to this, right? Although I might be a little bit frustrated where we are, thinking that the market's a little bit overdone. I by no means can see that we're going to lose 60% of our value within the next 15 or 16 months.
Two and a half years. 2.5 years.
2016.
Late 2016.
It seems like a very, very big prediction.
Well, what about 2008 and 9? Did anybody predict that? Did anybody predict the Japanese collapse?
I think
we did, by the way.
Did you predict it?
I did predict it in 1989. Look back in my books. Nobody saw it coming.
We want to talk about the future, not the past at this point. So what is going on right now, Harry, that's going to cause Dow 6,000 by the end of 2016, which is what you're calling for here?
Okay, China has a bigger bubble than we ever had, or even the Japanese in real estate. It is starting to show cracks. They're going to try to prevent it from bursting. When that bursts, there's nothing the Fed can do. Our real estate recovery is weakening because it's mostly speculation, not real families buying for real reasons. And Germany has a steeper demographic downturn than I was predicting for Japan in the 1990s when nobody saw them collapse. Those are 3 big things that could happen. They're not going to happen tomorrow morning, but any of those things breaks and people are going to lose faith in the Fed. People think the Fed will not let this market go down. At some point they're going to be disappointed. When bubbles burst, they burst dramatically. They don't correct.
Did everybody hear the lies that he was telling? His book, he even said, we just saw the slide, and if I hadn't pointed it out to you, you'd be going, oh, okay, hey, man, he's got it wired. I mean, he's got this fancy chart up here, it's going up and down, and he's saying it's going to go down, and, you'd be buying into it. You would be buying into it. He said 2008 through 2010 on the book, I can go back on the slide if we need to, that we were going to have the Great Depression. Remember the copy on the book? But yet the market was up 30%. Even he doesn't know what he's talking about. And this is pervasive. It goes on all the time. You've got to turn it off. And that's why I showed the little kid cartoon, because he's an annoying sound. Every time I see him, I think, oh my God, Harry's at it again. Poor Harry. He just can't seem to get it right. Another prognosticator, Hussman, sell your stocks now. He's a bearish manager. He warns that stock valuations are past their 2000 peak and that investors who don't sell now will ask, what was I thinking? Really? And here's a little more verbiage from Hussman. Though we fully anticipate the 2008 credit crisis and had no qualms about valuation after the market plunged, the imperative of stress testing against Depression-era outcomes prevented us from accepting opportunities in the recent half cycle. You know what that says? We got it wrong. The market rebounded and came back up. Prevented us from accepting opportunities in the recent half cycle. They got it wrong. But trust us now. We got it right now. I promise you. But that miss, he adds, should not be a reason for investors to ignore the objective risk over the completion of this cycle. From what is now the richest broad market valuation that investors are likely to observe in their lifetimes. We blew our call before, but come on, trust us, we got it right now. It's the future. Nobody knows what's going to happen. We've got some former FAA people in here, and I will bet you to a man or woman, nobody in this room, in fact, nobody in the United States, nobody in the world except those that were involved, knew September 10th, 2001, what was going to happen on September 11th. Nobody knew. It's the future. It's unknown. Once it's known, then it gets factored into the price of the stock. But it is the future, and called the future for a reason. It's unknown. So when you see these people making prognostications and making predictions, if you have to have a prediction to make your portfolio work, it's already broken.
Turn it off! Pull it back! Pull it back! I got it.
Oh. Tremors. That's from the movie Tremors. And you hear them talking about tremors in the market, and that 2009 was just a tremor, that the follow-on is going to be even worse. I really like that movie. It's so bizarre. It's fun to watch.
Harry, is this a technical
Here's our buddy Harry.
retest of the March of 09 lows that you're calling for, or is something fundamentally going to happen that's going to send us back down there again?
Well, again, the U.S. Stimulated the last crisis with our subprime crisis, but the world was awash in debt, unprecedented debt, and demographic trends for the baby boom were set to slow. Now we got the same thing replaying with Europe set to be the trigger this time with their sovereign debt crisis. We've got even greater debt ratios now in most countries around the world, and demographics is getting ready to slow even more in the next few years. So I think we're primed for a crisis, but this time it's going to be Europe that triggers it, not our fiscal cliff, not our Fed. And if we could take the whole world down, Europe can take the whole world down. And think of it this way. We've had two bubbles, and now we're in a third one. Each bubble has taken us a little higher. Each crash has taken us a little lower. So 6,000 is simply the bottom trend line through those bottoms, including the 64.40 in early 2009, and it's just a slight new low. It's not anything that should be unexpected given the trend.
Sounds plausible to me, right? Any of you buying it after all the things I've pointed out? Good. So when he aired, that was June 17th to July, Dow was up 34%. Those tremors really didn't work too good. He's probably sitting there going, ooh.
Give me my money.
No, I said no.
No, I want my money. I
said no, partner. Get out of here.
Nah, you went and did it. I might need that money tonight. I've never had pains like this before. Oh, this is the worst one I ever had, son. Oh, it's the worst one. This is a big one. I'm dying. You hear that, Elizabeth? I'm coming to join you, honey. Oh. Maybe that's Elizabeth.
Sounds like all the prognosticators we've been seeing, Harry Dent, Rubini, all of them. It's the big one. It's coming. I'm coming. It's the big one. The market will go down 30% of the time. The market will go up 70% of the time. You got to be in it to win it. let us do our job, and we will make sure that you're taken care of and that your portfolio does what it's supposed to do.
What is this? You keep saying crash. I mean, how significant a crash are you expecting? Haven't you been predicting this for years and it still hasn't happened?
Well, it's in the process of happening, and many of my predictions have come true. But we have to prepare ourselves for the fact that interest rates are going to go way up. And when they do, all those banks that we bailed out because they were too big to fail, they're all going to fail again. And this time, we're not going to be able to bail them out. The housing market isn't finished going down. It has to go down more, and the government cannot afford to pay the interest on the national debt, let alone retire it when interest rates go up. So we're going to have to come to terms with these massive macroeconomic imbalances of spending too much, of borrowing too much, of not producing enough, not exporting enough, not investing enough. All these things that the Fed is papering over with QE, we're going to have to deal with these problems. And they're much more massive today than they were in 2008. So if you thought that downturn was bad, you ain't seen nothing yet.
Just read an article recently. The banks have more cash on hand in deposits than they do outstanding liabilities. Normally it's the other way around. They want to get the money out there and get it working. So they will pay you what's interest rates on CDs now? About 0.5%. If you go out about two or 3 years, pay you 0.5%, and then they loan it to somebody that's buying a car for 8 or 9. They're playing the spread. That's arbitrage. Is basically what they're doing. But they have more money in deposits, and they're not making loans. They learned their lesson from 2008, 2009. They're not making loans. They've got the cash on hand. And I don't see an issue, even if interest rates do go up. They'll just raise the interest rates on car loans and credit cards and things like that. So all these prognostications and everything and all these predictions are just that. So what did investors miss? It was bad. The top was 11 of 07, November of 2007, to the bottom, which actually, like I said, was March 19th of 2009. S&P was down 50%. The CRSP 910. What is the CRSP 910? It's the Center for Research of Stock Prices. They break the stock market into deciles, and so the 9 and 10 is the lowest decile. So it's basically your small stocks and micro stocks. They went down 57%, and then your value stocks were down 54%. Nasty. Pretty darn nasty. Wayne was a client then. Scary, wasn't it? Well, how about from the bottom to present? Or June of 2014. 3 of 09 to June of 14. S&P total return 198, almost a 200%. Annualized 22%. Your money would have doubled. CRSP 910, a triple, 320% total return. Now remember, the negatives on there were all around 50, down 50%. If you have some of your money in the CRSP 910, you just did a triple. Do you care that your portfolio went down a little bit? Not when you get a triple. The Russell 2000, another double, 23%. 30% a year on the CRSP 910, the small caps. All right, pre-crash to present, 1107, which was the top, till today. You're still looking at a total return of 46%. Not bad. Annualized return of 5.9. CRSP 910, 80%. Annualized of 9. And the Russell 1000, 39%, or an annualized return of 5.9. Not great numbers, but not horrible either. If you just stay invested. So how about the growth of wealth? $1 million from 3 of 09 through 614. This is the S&P 500. This is the Russell 1000 value. And this is the CRSP 910. So from the bottom till June, 1 million would have grown just in the S&P almost a triple, 2.9. 3 million on the value stocks, and your small caps went rocketing along, and you've got a quadruple. That's why we diversify. That's why we go across all asset classes. That's why you have 12,000 unique holdings in your portfolio, and you're in 45